Plug Power, the hero of many investors' portfolio in 2020 that quickly became the villain in 2021. This stock experienced one of the worst meltdowns in a highly volatile time for momentum stocks, going from $75 per share in February down to a low of $18 in only a few months. The failure of the Texas power grid, coupled with the general deflation of the momentum stock and SPAC bubble, rounded off with the misrepresentation of accounting statements, led Plug Power down on a downward spiral of 75% below its all-time high. Many investors dumped their shares. A number of analysts downgraded their buy statuses across the board as Plug completed its mean reversion back to the long-term trend line. So is the worst of it over? Today I'm going to talk through this rollercoaster journey and its prospects for the future, as it charts its long climb back to the 70s and beyond. What's up YouTube? Welcome to Wise Wealth, where we dive into all things personal finance. If you're interested in stock analysis and general personal finance content, be sure to subscribe to my channel and hit that bell icon down below so you don't miss any new uploads. Without further ado, let's get into episode 10 of Stock of the Week. Plug Power is a leader in hydrogen fuel cell technology. They provide a clean energy alternative to standard internal combustion engines. Hydrogen can be a powerful source of energy, and when generated using electrolysis, the only byproduct of the energy production is oxygen, making it a true clean energy source. Hydrogen fuel cells have a strong use case in large machinery, such as forklifts or commercial vehicles, because the diesel alternative is known for its environmental impact, and the battery technology becomes less efficient the larger the payload becomes. The likes of Walmart, Amazon, and BMW are large customers of Plug Power fuel cells, where hydrogen is used to power machinery in warehouses and fulfillment centers for large enterprises looking to operate sustainably and work towards net zero emission targets. Plug Power has had a turbulent time in 2021 to say the least. The stock hit an all-time high of $75 among peak optimism in the stock following noteworthy business updates from the management team. They anticipated over $1.7 billion in revenue in 2024. Clean energy stocks were also center stage in the momentum trade following the election of Joe Biden, with many expecting significant government support for the sector moving into a world where sustainability is at the heart of so many strategic initiatives for both government and enterprise. So what exactly went wrong for Plug Power, and how did we go from $75 per share to $18? To kick things off, the day after reaching its all-time high, the company announced a share offering priced at $65 per share. The company raised $1.82 billion in the process, sending shares sharply lower on the news. Little did investors know, this was only the beginning of a steep decline. Shortly after this, extreme weather gripped the United States. Power grids failed, leaving many stranded in their homes without electricity or heating. In an attempt to push back on much of the criticism he was facing, Greg Abbott, governor of the state of Texas, blamed renewable energy sources for the failure of the grid, a statement that was later retracted due to its unsubstantiated claims, but the damage had already been done. Renewable energy stocks saw their worst day in many months, sending share prices lower by double-digit percentages. By now, Plug had been trading in the low 50s to high 40s range. To put this into perspective, most analyst price targets ranged anywhere from $60 up to a street high of $85 per share. To many, this seemed like a low range given the massive growth expectations of the company, but the real pain was soon to begin for investors. On the 16th of March, Plug Power announced that it will restate its previously issued financial statements for fiscal years 2018 and 2019, and its quarterly filings for 2019 and 2020. This was a result of consultation from KPMG, Plug's auditors, who identified that Plug was misrepresenting figures due to errors relating to lease accounting. Financial statements are the only true way investors can attempt to value a company, and as the credibility of these statements were called into question, investors panicked. On the announcement, the share price plunged over 30% into the low 30s. many investors lost confidence in the company itself, and in particular the management team. The success of Plug's growth is dependent on strong execution, and this was a turning point where many investors lost conviction in the company. As if the timing was not bad enough for investors, it only seemed to get worse. This coincided with the general deflation of the SPAC and momentum stock bubble. Stocks that were in favor among retail traders for the strong upward momentum and innovative concepts were falling out of favor. Inflation expectations were peaking and treasury yields spiked. These hurt equity valuations due to the way that the present value of a company is derived from its revenues. Growth stocks like Plug and others suffer more as the price of the stock is highly dependent on the future growth of revenue. This slow bleed dragged Plug down into the 20s and for a short period even as low as $18 per share. Looking at Plug's financials, can we put these prices into perspective? To do that, we first need to highlight that Plug is known as a revenue growth story. This means that the company does not turn a profit right now, but forecasts to do so in the future. It invests heavily in research and development and capital expenditure today to bear the fruits of its investment years down the line. Investors buy into revenue growth stories while they are doing this, with the expectation that their investment will be worth multiples of what they put in. As you can see from the financials, Plug continuously reports negative earnings per share, meaning we cannot put a PE ratio against Plug, a metric that is commonly used to describe the price of a stock. Rather, we must use a price to sales ratio. At its all-time high of $75, Plug's price to sales ratio was 67.7, a ratio that is considered extremely high for any company in any industry. You could say that management was smart to recognize this by executing their share offering at $65, as Plug was overvalued at that price. With a price to sales ratio of nearly 70, a lot, if not all, of their future growth expectations were already priced in. With Plug currently trading at around $29 per share, the price is much more attractive from where it was, but it is still not cheap by any means. Valuing the company seems to be difficult to newcomers, as its most recent statement reported negative sales, resulting in negative revenue for 2020 of $93 million. How exactly can a company report negative sales? This had to do with the vesting of warrants by a large customer in the final quarter. The value of these warrants exceeded the revenue generated, in effect meaning that Plug was technically paying its customers to use its products. How exactly has Plug funded this? Through continuous share offering and dilution of investor value. The financials do not paint a great picture today, but what exactly does Plug have in store for the future? A more positive note from earnings calls suggests that there is a lot more upside potential. These have come in the form of some interesting enterprise partnerships. Some of these partnerships include SK Group. One of the leading South Korean business groups announced a $1.6 billion capital investment in accelerating hydrogen as an alternative energy source in Asian markets. Renault, a 50-50 joint venture based in France, targeting over 30% share of the fuel cell powered light commercial vehicle market in Europe. Acciona, a 50-50 joint venture headquartered in Madrid, providing a green hydrogen platform serving clients in Spain and Portugal. Gaussian, a collaboration to provide a commercial suite of Pro-Gen powered Gaussian transportation vehicles to market in 2021. And BAE Systems, a collaboration to offer hydrogen-based electric propulsion systems for transit bus fleets. Plug Power have continuously reiterated that these partnerships are all upside potential and not reflected in current revenue forecasts, indicating that Plug could be conservatively forecasting for the future while surprising investors with better numbers to come. There is also potential for further partnerships in data centers, with Microsoft rumored to be in talks with Plug to decarbonize the management of their data centers. Other projects of interest are JLR's recent announcement of a production of a hydrogen fuel cell powered Defender prototype, and the world's largest $5 billion green hydrogen project ongoing in NEOM in Saudi Arabia. Plug Power is a risky investment subject to high levels of volatility. Their solutions are highly innovative that could significantly disrupt the energy industry, but relies on the great execution from management. This management team has question marks around them, with some questionable practices, including a share offering at $65 before financial restatements were announced, and also the selling of personal shares by the CEO near all-time highs. Given the volatility and current trading ranges, I think Plug is worth picking up if it falls into the high teens or low 20s once again. But in order to justify returning to its all-time highs of $75 and beyond, the company needs to provide consistent revenue growth over the next quarters that don't include nasty surprises such as the vesting of warrants seen in the last quarterly earnings. Negative sales will not lead to sustainable growth in the share value. For this reason, I am going to give Plug a 6 out of 10 and a hold rating. If you like this type of content, be sure to hit the like button down below, subscribe to my channel for more stock analysis and investing content, and hit the bell icon down below to get notified when I upload new content. Thanks for watching, and until next time, see ya.